Most traders operate minute to minute, reacting to every flicker of price action with adrenaline and anxiety. Surviving requires expanding that scope to a 5-year horizon. It is a slow, methodical grind where daily fluctuations matter far less than long-term capital preservation. To trade over a 5-year period, you need capital. The market offers 2 structural paths to get it. You can lease funds from a proprietary trading firm, commonly known as a prop firm, or you can trade your own personal capital. Leasing capital from a prop firm gives you immediate access to large balances, but it comes with severe structural constraints. These firms impose rigid daily drawdown limits and keep a percentage of your profits. To avoid breaching the rules, traders are forced into a defensive, short-term mindset, constantly trying to lock in small wins, rather than capturing larger long-term trends. Using personal capital removes those external limits, allowing you to keep all your profits. However, without a prop firm's strict rules, you operate without a safety net. You are entirely exposed to human emotion, greed, fear, and the impulse to over-leverage, which usually results in total account depletion. You either trade under restrictive rules that strangle your upside, or you trade freely and risk destroying your own money through a lack of discipline. Surviving half a decade requires significant capital and flawless execution, forcing traders into a very narrow set of highly flawed options. This flowchart maps out exactly where a profitable trading strategy breaks down in real-world application. Human execution introduces variables that math cannot account for. A manual trader will inevitably skip valid setups out of fear, force trades when the market is flat, exit a position before it reaches its target, or hesitate and enter a trade too late. Each of these psychological errors inflicts measurable mathematical damage.
Skipping setups destroys the system's expectancy, the average return you can mathematically expect per trade. Overtrading adds excess risk. Early exits severely reduce the potential reward, and late entries guarantee worse pricing. You can design a perfect theoretical system, backtest it over thousands of hours, and verify its edge. But if the person clicking the mouse deviates from the rules by even a few percentage points, the mathematical advantage disappears completely. Bridging this gap requires an automation framework. PropTrader Pro is an execution engine designed to operate a trader's existing strategy. It removes human variability by executing the same logic every session across every market condition, acting as the structural fix for both the prop firm constraints and the personal capital risks. Whether you lease money or own it, you cannot outlast the market while making manual execution errors. Total elimination of human deviation from your rules is a mandatory requirement to survive a 5-year timeline. In the prop firm ecosystem, the margin for error is effectively zero. A single emotional response, chasing a loss or holding a losing trade too long, will trigger the firm's strict drawdown limit, resulting in the immediate termination of the account. Manual traders trying to survive these strict rules adopt a highly defensive posture. They take smaller targets, cut winners early, and pass on high probability setups if they fear a temporary pullback might breach the firm's daily loss limit. This defense keeps the account alive, but severely caps the potential upside. By delegating execution to an automated engine, the trader removes the hesitation. The software deploys aggressively into the market environment, following the exact parameters of the strategy. It acts as an autonomous barrier against market volatility, continuously executing without fear of the prop firm's rules. This chart displays how PropTrader Pro manages risk dynamically. If the account equity begins to drop toward the prop firm's rigid termination limit, the software deploys its own internal limits. It enforces predefined session cutoffs and trade frequency limits, drawing a hard line above the danger zone. The automated intervention halts all trading activity before the firm's rules are ever tested. It effectively blocks the account from being blown, locking in the remaining equity and preserving the trader's funded status for the next session. The trade-off here is absolute. To gain this level of protection, you must completely surrender control. When the system shuts down to protect your capital, you cannot override it to attempt a discretionary recovery trade. Automation imposes strict internal discipline, severing the connection between an emotional trader and a fragile prop firm account. It neutralizes the risk of external punishment by stopping the bleeding before the firm ever has a chance to intervene. The alternative to leasing is the capital ownership model.
By allocating and trading personal funds, you completely eliminate profit splits, restrictive timelines, and external drawdown rules. The capital and its growth belong entirely to you. But removing the prop firm's rules exposes a critical vulnerability. Without the threat of losing a leased account, a trader operating personal capital is highly susceptible to ill-disciplined sizing, increasing leverage after a string of losses, and quickly destroying their own funds. This diagram displays the compounding equation, calculating future value based on starting capital, growth rate, and time, linked to real-time account parameters.
PropTrader Pro uses dynamic risk calibration to automatically link your exact trade size to your live account equity. As the system executes winning trades and the account balance grows from $2,000 to $10,000, the position sizing increases gradually. The system scales up automatically, ensuring the trader captures the full mathematical benefit of a growing account without manual recalculation. The process also works defensively. If the strategy enters a drawdown phase and the account equity drops, the position size immediately shrinks. This dynamic contraction preserves the core capital, ensuring a losing streak does not mathematically ruin the portfolio. Pure mathematical compounding comes with a significant requirement: extreme patience. During the early phases of a 5-year timeline, account balances are lower, and the system will strictly enforce small position sizes to ensure survival. Dynamic risk calibration enforces the exact same rigid discipline that a prop firm demands, but applies it to your personal wealth. It controls downside exposure mechanically, creating the stable environment necessary for exponential compounding. Applying a static, unchanging execution strategy to a dynamic market is a mathematical liability. Markets constantly shift between high volatility into tight consolidation phases and directional trends. Blindly executing the exact same setups, regardless of the broader context, rapidly degrades an account's edge. To navigate this, the execution engine relies on a real-time directional module. This acts as the software's sensory mechanism, constantly reading and interpreting the current market structure before allowing any trades to fire. Based on the structural data, the module dictates the system's posture. It determines whether the underlying strategy should seek long opportunities, scan exclusively for short entries, or pause operations entirely if the conditions do not align with the rules. Aligning precisely with market structure drastically reduces overtrading. However, the trade-off is that the trader must endure extended periods of zero activity when the market simply doesn't offer valid conditions. For a human trader, sitting idle is intensely frustrating. The psychological action of watching a screen for days while a system intentionally halts all activity to wait out an unfavorable market storm is one of the hardest disciplines to master manually. A machine does not feel bored. Forced inactivity during hostile market environments prevents the slow, persistent capital erosion that forces most manual traders to quit the industry entirely. This chart maps the execution landscape onto a 2x2 matrix. The horizontal axis measures the source of the capital, from prop firm, which relies on other people's money, or OPM, to personal capital. The vertical axis measures how the strategy is applied, moving from manual execution up to automated execution. The bottom left quadrant is manual prop firm trading. Traders here are caught in a cycle of passing evaluations, making minor emotional errors, breaching rules, losing their funded status, and paying to start over. The bottom right quadrant is manual personal capital trading. Without external rules, this is an unconstrained high-risk zone where human psychology dictates position sizing, inevitably leading to blown accounts and wiped-out savings. Migrating a prop firm user into the automated top left quadrant changes the dynamic. Here, the software acts strictly as a defensive shield, mechanically blocking the trader from breaching the firm's strict termination limits. Moving a personal capital user into the automated top right quadrant enables the highest mathematical potential. The software acts as an internal risk manager, strictly controlling drawdowns and scaling position sizes to support long-term exponential compounding. Regardless of whether you lease your capital or own it, relying on human execution keeps you in the failure zones. Migrating from manual to automated execution is the mathematically sound requirement to survive the 5-year path. Generating real wealth in the trading industry relies on ultimately transitioning to the capital ownership model. It requires trading your own money, keeping your own profits, and allowing those profits to compound over a multi-year horizon. Automation is not a magic bullet. PropTrader Pro does not generate signals or fix a broken system.
It requires an underlying strategy that is already theoretically profitable and mathematically sound. The software's entire function is the absolute and permanent elimination of human emotional interference. It ensures that the profitable theory actually translates into profitable execution by preventing fear and greed from touching the controls. By offloading execution and daily risk management to an automated framework, you free up your mental bandwidth. Your daily job shifts from anxiously monitoring individual ticks on a chart to focusing exclusively on researching and refining your strategy. This shift moves the trader from an anxious, reactive participant to a detached, systematic overseer of a compounding financial machine. Removing human execution variability provides the mechanical foundation for advancing from early learning to strict consistency to terminal capital growth over a 5-year timeline.